Thanks for checking out another clip of the Cashflow Contractor. We'd love to have you as a part of our audience. Click subscribe wherever you get your podcast. So what you'll do is you'll go over to this in the last tab, the profit first analysis. Let's say we're doing 1.5 in top line revenue and we have 750,000 in real revenue, right? So we basically are operating at a 50% gross profit margin, which we're doing really great. So on this, if I remember my taps from the last page, I'm in between 500,000 and 1 million in real revenue. So over here, what I want to do is put 20%. Target is, let's go back and look at that. Taps, 15, 20, 15, 50. So I'll just go in here, 15, 20, 15, 50. Okay. So we have that there. Then we can, if we knew what our actual was, which we don't know now, but maybe we have our historic data and we know exactly what these were, we can go ahead and put this information in right here. So let's say that I know that our profit was actually 7%. And let's say that, okay, 150,000, I actually paid myself less than that. And sorry, this is actual dollars. So what we'll say is that our actual net profit, let's call it 10% for easy numbers, was 75,000. Okay. So then our owner's pay, let's say it was, I paid myself 100,000. And then our tax, let's say our tax bill, we were able to get away with 50,000. We got lucky. We had some expenses that we were able to write off, right? And then our operating expenses, so basically our overhead outside of our owner's pay. And so I can see that basically this is the number I have left. So let's say my expenses were 525, just to say that we used all of that revenue. Okay, so now we have a zero here, meaning we've calculated all this out. Obviously, these are really rough numbers, but that's what we have. So what that gives us is it tells us how we're doing comparatively, right? So if we were making this 750 in real revenue, and these were our percentages, this is where we should be. So we should be having more profit. We're less profit. We're missing our profit target by 37,500. We're missing our owner's pay by 50,000. We need to increase that. And then we're missing our tax by 62,500. That 62,500 was probably inside of our operating expenses, which lowered our tax burden. But we need to decrease our expenses by 150,000, right? And you can see that if we decreased our operating expenses by 150,000, which is a huge lift, then what that would do, we would pay more in taxes, but we would have more owner's pay for ourselves and we would have more profit for ourselves. So what happens over here is these historical allocation percentages, rather than target, this is looking backwards. It shows us that we are really operating at a 10% net profit margin, and we are paying ourselves 13% there. So really our sellers' discretionary earnings, not including some that are probably in the operating expenses, are really 23% of this business, right? So pretty good, honestly. But from there, you would try to set your current allocation percentages for each quarter. Meaning, hey, I'm at 10% currently, and I need to increase. The fix is to increase my profit percentage, and I'm at 10% currently. Let's see if I can increase 1% each quarter. So I'm going to put in 11% here, 12% here, 13% here, and then 14% here, right? So those are my targets, right? And what that's done, you'll see here on these quarters. So this is Q1, Q2, Q3, Q4, it has increased the percentage for each of these quarters, right? So I'm trying to get 1% better at my net profit each month. And the idea is that you're paying your profit first, and then you're working out of your operating expenses after you've already paid your profit. So it causes you to shrink your spending. Hey, I don't have the cash to do it. I can't pay for it, is essentially the thinking. Let's go through each of these and figure out what the fix is, right? So the fix is that I need to increase how much I'm paying myself. Right now I'm paying myself 13%. I need to get to 20%. So 13.3. So let's just slowly increase that. Let's say that we get to 14, and then let's do 14 again for the next quarter, because I don't really need to pay myself that much and I'm trying to reduce expenses. Then I'll do 15% and 15%, we'll say, okay? That's what I'm deciding to do and how much I want to improve. Then we have our next one. We need to increase our tax, right? And how much we put towards our tax. We've really only been putting 6%, and we need to be getting closer to 15%. I'd really like to, I don't want to owe the tax man, so I'm going to put 10% here and then 11%. So a big jump right away, but I'll get better and better as we go. And so hopefully we can end the year at 13% in the fourth quarter of how much we allocate to our tax account. Our operating expenses right now, we're at 70% historically, and we're trying to get down to 50. That's a lot to decrease. I'd have to decrease our expenses by 5% each quarter. And so, or really more than that if you think about it. But the reality is, let's see if we can get it down to 67%, or maybe we can do a big cut right away in the first quarter and we can try to get it down to like 62%. And then from there, let's see if we can take it 2% each quarter. So 60%, and then 58, and then 56. Okay. So now it's going to tell me, hey, you haven't actually filled out all of these, right? So I still have some extra left over. So let's see, probably realistically, it's good that I probably add this back to my expenses. So I'll do 65% here. And then maybe what I can do here is do a bigger jump on my taxes to 12. And then I'll put this at 62. We have 2% left here. Let's say that I really want to, let's really get that. I think we should focus on that tax account. So we'll do 13% and 59%. And then let's do the same thing here, 57 and 14, right? And that gets us closer to where we want to be of that 15%. You can see that we're at 0% left over. All of these quarters have been adjusted, right? So we're doing well. Now, the only hard part here is, especially for contractors, is they bring in this revenue, but they don't have a way of tracking the real revenue in real time, meaning they're getting the revenue and it has their cost of goods sold and their materials and labors inside that revenue. So what I recommend doing is actually having another account be like I would have a real income account and then like a all income account essentially. And then I would on top of that have a COGS account. So essentially you get that real revenue or the top line revenue in, immediately put what you need to put into cost of goods sold into your cost of goods sold account. And then the rest is your real revenue or real income account, right? So right away, you know, you're not tracking inside of your profit first analysis what your cost of goods sold is inside of income. So hopefully that's a helpful exercise. But I would make sure that you're mindful of that as you go through this. Thanks for checking out a clip from the Cashflow Contractor. We have full episodes where we go deep on topics that help you grow a construction business that runs without you so you can have less stress, more time, more money. Now, we've got other videos, other clips, but if you want to check out the full episode for this clip, you can click wherever our editor put it. It might be here, it might be there, it might be over my face, I don't know. But Thank you for checking us out. We'd love to have you as a part of our audience. So subscribe or check out a full episode wherever you get podcasts.